In accrual-based accounting, we have timing differences, as we discussed in this section on accounting theory. Those timing differences sometimes give rise to what we call valuation accounts, or Contra accounts, as they are sometimes called. They involve estimates, as we shall see. Let us now look at some examples. In the financial statements, equipment is shown at cost of $10,000, and accumulated depreciation is shown as a credit balance offset to the equipment account. $10,000 less accumulated depreciation, $2,000, equals net book value, $8,000. Next year, another $2,000 will be charged to depreciation expense, and an additional $2,000 will be credited to accumulated depreciation. Here we see the debit to depreciation expense of $2,000 and the credit to accumulated depreciation of $2,000. The credit is a Contra account. Let us assume that we bought some computer equipment for $10,000. We have a whole chapter devoted to the subject of depreciation later in the course. Here we are going to estimate a useful life of 5 years, and depreciation expense is charged ratably in straight line over the 5 years. The first year depreciation expense would be $2,000. As shown, we have a debit to depreciation expense for $2,000 and a credit to accumulated depreciation, $2,000. The depreciation expense taken is an estimate. The accumulated depreciation is a valuation or Contra account. In this case, we call it a Contra asset account. Its normal balance is a credit. In the event of a sale of merchandise or services on account, we have a debit to accounts receivable, in this example for $40,000, and a credit to sales in the corresponding $40,000. The matching principle states that revenue is recognized as earned and expenses as incurred. With sales on account, we have essentially made an extension of credit to our customer. There is some prospect that not all of the accounts receivable will be collectible. If terms were 30 days to pay, then some accounts receivable might not be collectible. We need to estimate that loss and match it with the revenue. We debit bad debt expense and credit allowance for doubtful accounts, a valuation or Contra asset account. How to make that estimate? We can do what we call an aging of the accounts receivable subsidiary detail. We can look at accounts that are 30 days past due or less and take a percentage to bad debt based on past experience. Accounts that are 30 to 60 days past due are charged a larger percentage to bad debt. Those invoices more than 60 days past due should be looked at individually to see if collection is possible. We would look at individual large invoices in each category and try to collect. Let us assume that the estimate for bad debts is $1,500. We debit bad debt expense for $1,500 and credit allowance for doubtful accounts, $1,500. The allowance is a credit or offset to accounts receivable, a Contra asset. To be sure, it is an estimate. First, we have the journal entry to record the bad debt expense. Debit bad debt expense, $1,500. Credit allowance for doubtful accounts, $1,500. Then we have the balance sheet showing accounts receivable, $40,000, less the allowance for doubtful accounts, $1,500. Net accounts receivable, $38,500. The bad debt expense account is in the period of sales. If a specific account becomes uncollectible, the entry is debit the allowance for $100 and credit the specific accounts receivable, $100. It is a debit or decrease of the allowance account, and a credit reduction of accounts receivable. A warranty expense is a cost incurred to guarantee the performance characteristics of a product or service. Consider the case of one Korean automaker, Hyundai Motors. It sells its vehicles with a 10-year, 100,000-mile powertrain warranty. If we are matching expenses with revenue, then the warranty expense must be paid out over 10 years, or 100,000 miles. All 10 years' worth of warranty costs must be estimated in the year of sale and charged to that period. The warranty helped make the sale, so all the warranty costs must be charged to year one. We do that with a debit to warranty expense and a credit for $35,000. The company estimates $2,000 for warranty expense for the 10 years of the warranty. The expense is recognized in year 1, the whole $2,000. Let us assume that the company in year 2 pays $300 for warranty work. It is credit cash and debit reserve for warranty. No expense is charged, it is cash down. Reserve for warranty down. How significant can warranty be? 500,000 cars. It could be billions. And in financial accounting, it is an estimate. FYI, I had purchased a high-end car that had a defective radiator. Over a 3-year period, the cost for my one car was $1,200, times tens of thousands of cars. A, contractor creates a $50,000. B, $2,000. C, 0. The answer is 0. The deposit is a debit to cash and a credit to unearned revenue, a liability for $2,000. No work is performed, so no revenue is recognized. Journal entries JE6 to JE10, summarized on this slide. Notice that debit-credit equality is maintained. JE6, sales commissions $800, cash $800. JE7, administrative expenses $700, cash $700. JE8, cash $4,000. Accounts receivable $4,000. JE9, accounts payable $5,000, cash $5,000. JE10, cash $2,000. Unearned revenue $2,000. Here we see the T accounts and the impact of journal entries 6 through 10. Number 6, paid sales commissions. A debit of $800 to the commissions account and a credit of $800 to cash. Number 7, paid admin expense $700. Credit to cash $700. Number 8, collected on an account receivable. Debit cash $4,000. Credit accounts receivable $4,000. Number 9, paid down accounts payable. Debit accounts payable $5,000. Credit cash $5,000. Number 10, received cash not yet earned. Debit cash $2,000. Credit unearned revenue, a liability not revenue, $2,000. Advertising is paid in a prior period. Expense in the current month is 0. Expense paid but not incurred. Prepaid advertising is an asset. Debit prepaid advertising $1,200. Credit cash $1,200. In the active month, advertising expense is debited for $1,200 and prepaid advertising is credited. Cash outflow in prior period, expense recognized in the period of use. The telephone expense is in January. It is not paid until March. At the end of January, we recognize the telephone expense with a debit to telephone expense and a credit to accrued telephone expense for $1,000, a liability. Then when the bill is paid, we debit accrued telephone expense, a reduction of a liability, and credit cash. Notice that it does not matter when we pay the bill. We recognize the expense in the month it was incurred, which is January. Sales on account means we have extended credit terms to our customers. Revenue of $9,000 is recognized in January because the goods or services were delivered. If we collect the $9,000 in February, we debit cash, $9,000, and credit accounts receivable, $9,000. Revenue was recognized in January. The receipt from customers in February does not impact an earnings statement account. It is debit cash, credit accounts receivable. Sales on account means we have extended credit terms to our customers. Revenue of $9,000 is recognized in January because the goods or services were delivered. If we collect the $9,000 in February, we debit cash, $9,000, and credit accounts receivable, $9,000. Revenue was recognized in January. The receipt from customers in February does not impact an earnings statement account. It is debit cash, credit accounts receivable.